In 1929, Joseph Kennedy exited the stock market just weeks before the crash. When asked why, he said, "If even the shoeshine boy is giving stock tips, it's time to get out." That move saved his fortune and made him richer when others were ruined. In 2008, Michael Burry and John Paulson spotted the housing collapse before anyone else. They didn't predict the timing. They followed the signals. Both shorted subprime mortgages and made billions while Wall Street burned. In 2020, Bill Ackman turned a $27 million hedge into $2.6 billion in just 30 days. While others panicked, he was already prepared. Now, in 2025, it's happening again. Buffett is holding $157 billion in cash. Bezos and Zuckerberg have sold over $12 billion in stock. Insider selling is at record highs. The put/call ratio is surging. And yet, retail investors keep buying. Same signals, same setup, same pattern, because smart money doesn't react to crashes. It prepares for them, always. There's a four-stage pattern billionaire investors follow before every major collapse. It's not magic. It's not timing the top. It's a sequence, tested across centuries, that turns volatility into opportunity. Stage 1. Early exit. The insiders sell while valuations are high and sentiment is euphoric. Stage 2. Buy insurance. They load up on puts, hedges, and credit default swaps. Stage 3. Targeted shorts. Sniper plays on fragile sectors already cracking. Stage 4. Buy at max fear. When panic peaks and assets are mispriced, they reload. This is not theory. It's the exact playbook Kennedy used in 1929, Burry in 2008, and Ackman in 2020. The crowd rides the hype. Smart money rides the exit. Right now, every warning signal is flashing. The S&P 500 trades at a Shiller P ratio of 30.1, higher than 87% of market history. Margin debt stands at $780 billion, near all-time highs. The put-call ratio has surged past 1.4, showing serious institutional hedging. And yet most retail investors are still chasing momentum. AI stocks, meme stocks, crypto rebounds, all the same signals we saw before previous collapses. But the billionaires are already moving, not because they fear the crash, but because they expect it. Stage 1 is always the most invisible, because it looks like nothing is happening. No headlines, no panic, just quiet exits while the crowd celebrates. In 1929, Joseph Kennedy famously dumped his stocks after hearing market tips from a shoeshine boy. That wasn't luck, it was awareness. He understood that when everyone is all in, there's no one left to buy. Fast forward to 2007. Buffett quietly reduced his exposure to banks, while retail investors kept piling into financials. At the same time, Michael Burry took massive short positions on mortgage-backed securities, years before the crash. And now, in 2025, the same behavior is unfolding again. Warren Buffett's Berkshire Hathaway is sitting on $157 billion in cash, the highest in its history. He's not buying the dip. He's not chasing hype. He's waiting. Meanwhile, Jeff Bezos and Mark Zuckerberg have sold over $12 billion in personal stock holdings this year, not to fund ventures, not to pay taxes, to exit while prices are high. The Insider Selling Index, which tracks how much stock corporate executives are offloading, has surged to record levels in Q3 2025, according to Open Insider. What does that mean? It means the people who know their companies best are getting out. Retail, however, is still in, driving up margin debt to $780 billion. Leveraging into AI, crypto, and tech with the belief that this time is different. But it never is. Stage 1 is not about timing the exact top. It's about exiting when everyone else is blind. Because by the time the headlines hit, the smart money is already gone. Stage 2 begins quietly, not with panic, but with protection. This is when the smart money doesn't just leave the table. They buy insurance on what's about to burn. In late 2006, Michael Burry started purchasing credit default swaps on subprime mortgage bonds. Everyone thought he was early. Some thought he was wrong. He wasn't. By the end of 2008, he had returned nearly 490% to investors by betting against what no one wanted to see. In March 2020, Bill Ackman spent $27 million on hedges against corporate credit and equity markets. When COVID hit, he made $2.6 billion in under a month. That's stage 2. Buy protection when no one else sees the fire. Right now, in 2025, that fire is already visible to insiders. The CBOE put-call ratio, which measures how much downside protection institutions are buying, has surged above 1.4. That's not retail fear. That's strategic hedging by funds who know what's coming. Credit default swaps are rising again, particularly in commercial real estate, regional banks, and high-yield corporate bonds. These are the weak points of the economy. And smart money is quietly positioning. Look at Bridgewater. Look at BlackRock. Look at the options flows from major desks in Q3 2025. Puts on CRE, insurers, and leveraged tech. Retail, meanwhile, is still unhedged, still buying dips, still repeating 2008 and 2020 without learning the playbook. Stage 2 isn't about fear. It's about foresight. It's the quiet moment when billionaires pay pennies for billion-dollar downside. And when the crash begins, those contracts become gold. Stage 3 is where the game turns aggressive. This is no longer about protection. It's about attack. The smart money starts shorting the weak, the exposed, the over-leveraged. And it's never broad. It's precise, surgical. In 2008, the targets were clear. Bear Stearns, Lehman Brothers, Countrywide, mortgage REITs, all overextended, all built on bad collateral, all collapsed. Today, in 2025, the new targets are forming, and the pattern is identical. Commercial real estate is breaking. Vacancy rates in major U.S. cities now exceed 30%. Refinancing is drying up, and $1.5 trillion in CRE loans will mature by the end of 2026, according to the Mortgage Bankers Association. That wall of debt can't be rolled over at 6% interest rates. Many properties were underwritten at 3%. The math no longer works, and institutional investors know it. They're shorting REITs, shorting mezzanine lenders, shorting CMBS tranches tied to office towers that no one wants anymore. Next target, zombie companies. These are firms that can't cover interest with earnings. When rates were near zero, they survived. At 5 to 6%, they bleed. Debt rollovers become death sentences. Smart funds are scanning balance sheets, isolating the weak, and betting on failure. And then, regional banks. In 2023, Silicon Valley Bank was just the beginning. In 2025, many small to mid-tier institutions still hold toxic CRE exposure and low-yield bonds marked far below par. Another rate shock. And they're gone. This isn't panic. It's execution. Stage 3 is when billionaires don't just wait for the crash. They aim at it. They target fragility. They amplify the cracks. And when the avalanche starts, they're already positioned at the bottom, waiting to collect. Because this phase is not about fear. It's about precision. Stage 4 is where the money is made. It's the ugliest phase, peak panic, media chaos, portfolios in free fall. But it's also the moment smart money moves back in. They don't wait for calm. They buy at max fear. In 1929, after the market crashed, real estate in Manhattan collapsed. Buildings sold for fractions of their value. The families who bought during that window, Rockefellers, Carnegies, locked in generational wealth. In 2008, while most investors fled, Buffett injected billions into Goldman Sachs and General Electric. His timing wasn't perfect, but the terms were. He bought preferred shares with guaranteed yields and upside, because fear gives leverage. In 2020, after collecting $2.6 billion from his hedge, Bill Ackman immediately flipped and bought into the recovery. He saw the reversal before the Fed even spoke. This is stage 4, liquidity meets despair. Right now, the smart money is preparing for it. Buffett's $157 billion in cash isn't idle, it's ammunition. Bridgewater has reduced equity exposure, increased dry powder. BlackRock is quietly launching funds aimed at distressed debt and opportunistic real assets. Why? Because every crash ends with forced sellers, margin calls, panic liquidations, assets trading below intrinsic value, and those with cash, real, liquid, unleveraged cash, become kings. The forecast for 2026 is not subtle. Morgan Stanley and other institutions have published base case drawdowns of 40–50% from current equity levels. That's not a correction, that's a reset. And in a reset, the prepared don't just survive, they reposition. Stage 4 isn't about timing the bottom. It's about buying value when no one else can. Because in every cycle, the fortune isn't made in the rally. It's made in the wreckage. So where are we right now in the pattern? All signs point to the final stages of setup, somewhere between stage 2 and stage 3. The exits have begun. The hedges are in place. And now, the targeting begins. Buffett is holding $157 billion in cash, Berkshire Hathaway's highest cash position ever. He hasn't made a major acquisition in over a year. He's not waiting for opportunity. He's waiting for capitulation. Insider selling spiked in Q3 2025. Data from Open Insider shows executives offloading shares across tech, finance, and consumer sectors at the fastest pace since 2021. Not random sales, but coordinated exits. Meanwhile, the options market is screaming insurance. The put-call ratio has stayed elevated above 1.4 for 4 consecutive weeks, a level associated with institutional hedging, not retail speculation. Commercial real estate is in freefall. Vacancy rates are north of 30% in office-heavy metros. $1.5 trillion in debt is maturing into a market with no appetite for refinancing. REITs are under pressure. Banks are tightening credit. High-yield bonds, the lifeblood of zombie companies, are seeing spreads widen. Some junk debt is already pricing in 10% plus default risk. This is exactly what preceded the 2008 unwind. And yet retail still believes. The S&P 500 trades at a Shiller P of 30.1. Meme stocks are back on TikTok. Crypto pumps dominate headlines. It's late-cycle euphoria dressed up as innovation. The billionaires have already moved. Early exit? Done. Insurance? Bought. Now they're lining up shorts, scanning the balance sheets, building dry powder. You're not early, you're not late. You're exactly in the middle of the pattern, and once stage 3 flips into stage 4, there's no time left to reposition. Here's what you do now. If you're not a billionaire, but you see the pattern. Step 1. Cut leverage. If you're trading on margin, reduce exposure. The margin debt pile is $780 billion, and when it unwinds, it will do so violently. Forced liquidations don't ask for your opinion. Step 2. Raise cash. Not because cash is exciting, but because it's optionality. Buffett holds $157 billion not out of fear, but because it gives him power when prices break. Step 3. Hedge. If you hold long positions, consider protective puts, inverse ETFs, or sector rotation into low-beta assets. The cost of insurance is still relatively cheap, until it's not. Step 4. Know what not to touch. This is not the time to chase AI stocks at 100x earnings. Not the time to YOLO into crypto based on influencer calls. Not the time to believe bubbles or trends. Avoid commercial real estate plays. Stay away from zombie companies with negative cash flows and debt maturities in 2026. Don't hold banks with outsized CRE exposure. These are ground zero when the cracks widen. And above all, don't think you'll get out in time. You won't. Markets fall faster than they rise. Liquidity disappears when you need it most. The exits will jam. They always do. Your job is not to time the exact crash. It's to prepare like it's coming, because every signal says it is. When the crowd is greedy, step aside. When the crash hits, have cash. When the dust clears, strike. This is the blueprint. Here's the forecast. not based on fear, but on the data smart money is watching. The reset window centers on mid to late 2026. That's when the weight of maturing debt, overstretched valuations, and a weakening consumer converge. Morgan Stanley's base case, a 40–50% correction in equities. Goldman Sachs warns of liquidity fractures in credit markets by Q3 2026. JP Morgan is modeling a CRE rollover event with systemic spillovers. Why now? Because the U.S. is entering a tightening lag. Rate hikes from 2022–2024 are still working their way through the economy. Corporate refinancing cliffs are approaching. Household savings are depleted. Student loans have resumed. Credit card delinquencies are rising. And the Fed? Its balance sheet is still above $8 trillion. QT has removed over $1.1 trillion in liquidity, but core inflation is sticky. If markets crash, they'll pivot. QE Round 5 is not just possible, it's expected. This isn't unprecedented. After every major collapse, 2008, 2020, the central bank returned as buyer of last resort. That's when the cycle restarts, and that's when the greatest fortunes are made. The key is survival. Those who preserve cash will buy distressed assets at 30–70% discounts. Real estate, energy, equities, bonds, venture. Everything reprices. But recovery won't be equal. This time it will be bifurcated. Smart capital will concentrate in select assets: AI, defense, green energy, and real yield instruments. The next bull run will exclude the weak, and by 2027, the economy may look better on the surface, but it will be owned by those who positioned in the wreckage. The question isn't whether a reset is coming. The question is who will be liquid when it arrives, because once the flood begins, only those who built arks will float. This is the pattern. Stage 1, early exit. Stage 2, buy insurance. Stage 3, targeted shorts. Stage 4, buy at max fear. It's the exact sequence smart money followed in 1929, in 2008, in 2020. And now, every sign points to 2026 as the next reset. They've already moved. The exits are underway. The hedges are in place, the short books are growing, and the cash piles are ready. Retail investors once again are late. High on narratives, deep in leverage, blind to signals. They think they'll ride the storm, but storms don't wait for permission. So ask yourself one question. If Buffett is holding $157 billion in cash, if Zuckerberg and Bezos are selling billions in shares, if insider selling is hitting record highs, what do they know that you don't? The cycle is turning, the clock is ticking, and when the lights go out, only those who studied the pattern will still be standing. Because this isn't about timing, it's about patterns.